Right now, we are in critical territory. Over $2 trillion has been wiped out from the crypto market in just days. And that same shockwave has hit silver, driving it all the way down to around $85 an ounce. Gold isn't safe either, sitting near $4,900 after its worst drop in recent history. But hold on, this isn't random chaos. This is a calculated setup, and here's why I believe banks might be trapped this time. We're potentially looking at the most explosive squeeze the precious metals market has ever seen. Stick around, because in this video, we'll dive into everything. The real triggers, the manipulation patterns, key levels, and I'll give you my exact price targets for silver and gold that could change the game for any one position, right? If this crash has got you feeling uneasy, hit that like button now, and don't forget to subscribe to Economic Narratives for real-time updates without the media noise. Let's break it down. Let's start with the facts. It's early February 2026, and the crypto market is in free fall. Bitcoin has plummeted below $76,000, down 40% from its 2025 highs of over $120,000. Ethereum is cratering toward $2,300. Solana is struggling below $100, and the entire crypto market cap has seen trillions wiped out within days. This isn't just a flash crash. It's a liquidity squeeze, and forced selling is spreading like wildfire. Geopolitical tensions are escalating, especially with the US-Iran issues. We've also got recession fears and AI-hype deflation. And to top it off, the Federal Reserve's hawkish stance is shaking confidence. But here's the kicker. This chaos is not limited to crypto. The contagion is spreading, and precious metals are feeling the pain, with silver at ground zero. Just January 2026 felt like the beginning of the greatest rally in precious metals history. Silver surged 68%, reaching all-time highs above $121 per ounce. Gold climbed 29%, pushing to $5,600. The momentum was strong. Dollar decline fears, massive central bank buying, retail investors fleeing fiat, and China and India hoarding physical silver. But then Friday hit, and silver suffered a 30% drop, marking its worst single-day loss since 1980, closing near $85. Gold fell 9 to 12%, and that's not a market correction. That's a massive wipeout. But here's why this is tied directly to crypto's crash. It all comes down to leverage, liquidity crunches, and cross-market correlations that institutions exploit. Crypto and precious metals are more intertwined than ever, and we're seeing the same patterns play out. The connection between Bitcoin futures and CME silver contracts is critical here. Both markets use the same algorithmic trading systems. When Bitcoin drops, it flips the risk switch across portfolios, and funds are forced to sell leverage positions to cover margin calls. This is exactly what happened in October 2025 when a crypto flash crash dragged silver down 20% overnight. It's happening again. And now, U.S. banks are in trouble. The first bank failure of 2026 has already triggered hundreds of billions in unrealized losses, and the dominoes are falling. Stocks, bonds, crypto, metals, it's all connected. The markets are tearing apart at the seams. Why silver? Simple. Volatility. Silver is always more volatile than gold. It's often 10 times more volatile, making it the perfect vehicle for manipulation. And when you look at the evidence, this is exactly what's happening. Banks like JP Morgan, HSBC, and Deutsche Bank have been fined billions for rigging silver prices through spoofing and manipulation, flooding COMEX with paper contract to suppress prices and protect massive short positions. Fast forward to 2026, we're seeing the same pattern. CME hiked silver margins repeatedly, forcing leveraged longs to liquidate as prices soared. And here's where it gets even more interesting. China has entered the scene. Shenzhen halted trading on a major silver fund, trapping billions at inflated premiums. The sell orders flood in from China, crushing prices further. Silver got nuked to $85, but that's not the end of the story. Physical demand is building. SLV vaults are draining. Industrial shortages are at decade-high levels. If delivery notices spike next month, the short squeeze will be unstoppable. It's déjà vu from 1980, when the Hunt brothers tried to corner the market and prices shot up to $50 before regulators stepped in. Today, it's the banks who are short, while retail and institutions are holding physical silver. Silver's setup is primed for a major rally. Let's break down the 3 paths forward for silver. Scenario 1. The bull trend resumes. The pullback was just a reset, and prices recover quickly. New highs follow in weeks. Scenario 2. The dollar continues higher, the Fed stays hawkish, and metals take another leg down before stabilizing. Scenario 3. Choppy, sideways movement frustrates everyone, shakes out weak hands, and sets up the next big move when attention fades. I assign the highest probability to a recovery scenario, but only if the dollar cools off. Here's where I stand. I believe silver will regain the $120 level in the near term once political uncertainty clears and the dollar's momentum slows. This will happen sooner than most people expect. This crash wiped out weak hands, but it exposed massive bank shorts and set the stage for the epic squeeze coming soon. Whether you're holding physical metals, trading futures, or sitting on cash, the next few months are critical. And remember, markets reward the prepared. If you think the squeeze is coming, hit like, drop your thoughts in the comments below, and subscribe to Economic Narratives for daily updates on this volatile market. We'll see you in the next video.